Over the 12 months to September, the CPI rose 7.3% and the Consumer Price Index rose 1.8% this quarter. So that is more than expected. So we did see food and non-alcoholic beverages go up. So the rise there was about 9%. One of the big rises was housing, which we are continuing to see. We talked about rents going up and also the cost of new construction. Furnishings went up about 7.7%.
What was the percentage on housing?
10.5%. We also saw, again, transport going up. As we've mentioned, we've got high petrol costs, higher cost of freight. Also, another big mover, we saw the cost of education and recreation and culture also going up. So recreation and culture going up about 5%. So the Bureau of Statistics says this is the highest annual consumer inflation since 1990. And they're saying the past 4 quarters have seen rises off the back of higher prices for new dwelling construction, higher prices for petrol and food. The trimmed mean annual inflation, which excludes volatile things like petrol and food and vegetables, increased to 6.1%. That's the highest since the Bureau of Statistics first published the series in 2003. So I'll come back to you now, Diana. So this was more than you were expecting.
Especially for the trimmed mean, the headline number was slightly higher than expectations, but I think the more important number here is what that trimmed mean, that underlying pace of inflation is telling us. We were expecting about 1.5, it was 1.8. I think that's quite a significant difference for a number like an underlying inflationary figure. So clearly what we're seeing is that some of these headline inflation drivers that we've been talking about for the past year, high food prices, the supply chain issues, all of that extra goods demand that is leading to higher goods prices is flowing through into the services sector. And even though wages growth isn't particularly high in Australia, it's still below 3% on an annual basis. It does look like services inflation is becoming a bit of a problem here in Australia. So this is, I think, what's going to be the big talking point for the RBA. Goods prices are likely to come down, as we were talking about before, because of lower commodity prices, some of the supply chain issues resolving themselves. Our inflation indicators around all those factors have been going down now for months. The flooding in Australia will add some near-term pressure to food prices, but I don't think it will add significantly to inflation in the short term. I think the problem is really services inflation. So the impacts of today's data, I think it will potentially cause markets to expect more RBA rate rises in the short term. We could see the RBA lifting rates more than anticipated.
Yeah, well, that's what I was going to come to. Now, you were expecting that there would be one more rate rise of 0.25 percentage point next month by the Reserve Bank. Does that change your forecast now?
I think that the risk is that we will see the cash rate rise another 2 times from here. So we did have, our expectation was that we would get another one in November, but I think that the RBA may be more concerned by today's data than we were previously anticipating, and we could see another rate rise either in December or early next year when the RBA comes back for its board meeting, because it does take a break in January. And the global environment could change quite significantly from the end of the year until February, because we are getting to the point where there could be a risk in financial markets or something breaks. We could see the start of a global recession or recession in one of the major advanced economies. We could see issues in financial market liquidity, which we've seen in the past few weeks around what's happening in the UK, and also the weakness in Chinese equities this week. So if we see some of those global issues become worse, then that could mean that rates don't go as high here. But I think with today's high underlying inflation prints, then the RBA may be forced to take rates above 3%.
Yeah, and if we, I'll just read out some of the other figures from today's quarterly inflation report. So again, there were labour shortages in the house industry leading to rises in labour costs. that contributed to the rise in new dwellings. And of course, gas prices also went up. Now, we heard in the budget that electricity prices expected to rise by 50% over the next 18 months, and gas prices up more than 40%. So we're certainly seeing that as well in the September quarter data, although that was offset by subsidies by the WA government, the Queensland government and the ACT government. But we're still expecting that inflation will reach nearly 8% over the whole year.
Well, we were previously forecasting inflation to get to about 7.5% by the end of this year, and I think with today's data, it will be closer to 8%, like you were mentioning. And next year, we do expect the pace of inflation to come down, but to still remain above the RBA's target band of 2 to 3%. So we think inflation will be somewhere at about 4.5% or 5% on an annual basis by the middle of next year, and by the end of next year to go towards between 3 to 4%. So obviously much lower than the 8% peak, but well above what the RBA would like. I suppose one of the problems is that interest rates can only do so much to get the pace of inflation down for items that are related to interest rate sensitive areas or to goods spending. Interest rate rises aren't going to do anything to impact the cost of energy or to impact the cost of food prices, which is being driven by commodities and flooding. So monetary policy can only do so much to get the pace of inflation down. Unfortunately, we may be in a situation like we are globally where energy prices will remain high for a number of years. And the only way that the government can help households in that situation is to give them rebates or some cost of living relief.
Now, we've got a graph we'll just bring up now showing that inflation has risen to a 30-year high. As you can see, back in the 1990s, it was above 8%. Obviously, came down a lot during the pandemic, and now back to 7.3%. So that's the highest in 30 years. The war in Ukraine and causing high energy prices has contributed to that, but also food inflation. We're expecting more food inflation because of the floods. Again, high petrol prices, high rents have also contributed to the high cost of inflation, so the high price rises. So, Diana, do you think some of those Treasury forecasts are too optimistic? As you said, inflation forecast to end the year at 7.75%. The Treasury forecast in the budget expecting price rises to ease to 3.5% by mid-2024.
Yeah, I did think that when I looked at the budget last night that their estimates for inflation for the middle of next year were probably a little bit lower than what we were anticipating, but not we're still within a range that I think is reasonable. So even with today's numbers, I don't think it would drastically change the overall assumptions that the Treasury was using, and so it wouldn't have much of an impact to the actual assumptions for the budget deficit over the coming years. I still think it's within that ballpark range of estimates being reasonable.
Another estimate is wage rises. Of course, wage rises have been pretty low, currently running at about 2.6%, way below the level of inflation. Now, the budget was forecasting wage rises at to reach about an annual rate of 3.75% in 2 years. However, if our unemployment rises to, say, 4.5%, we have more skilled migrants, won't that put a cap on wage rises?
I was thinking myself that the wage forecasts from the Treasury were a little bit higher. Our own forecasts are for wages to get to about 3.5% by the middle of next year. Wages do tend to lag a little bit what is happening to the inflationary environment at the moment, and also what's happening to the labour market. So the labour market is obviously extremely tight. The unemployment rate is at its lowest level in 48 years. Underemployment is extremely low, which generally tends to be very good news for wages. But it is lagging, all of these things. We need to wait some time before that comes through because people take some time to ask their managers for pay rises. EBAs take time to get filtered through as well. So that's why wages is lagging what's happening in the broader economy.
Now,
after that time...
Oh, sorry, go on.
After next year, I think wages growth will probably settle at about 3% on an annual basis. And that is a good level to settle at because that's sustainable. with productivity growth and growth in the labour force. And as you said, the getting the skilled migrants back into Australia, that will put upwards pressure on the unemployment rate, which could be negative for wages growth as well.
And if we go back to the budget and, of course, those high energy costs, do you think there should have been some sort of energy relief for consumers and business in the budget?
It's a difficult question for the government to address because, on the one hand, the state governments were giving some relief back, as we saw in the CPI figures today, through some rebates, but that wasn't a federal policy or mandate. So the state governments have the opportunity to give households some cost of relief pressure as well. Not all of, I don't think all the pressure should be put on the federal government because the state governments can do something as well. I think what needs to happen is that low and middle income households should be compensated, but in a way that doesn't add to the budget deficits or to federal debt. And the way that can be done is through using money from companies energy-related companies, or taxing these energy-related companies and using that windfall to then give it back to households. That would be a way to give some cost of living relief back to households without adding to inflation. The government instead opted to do longer-term policies like childcare and paid parental leave, but they don't start until next year. So really, it's not a cost of living relief because the policy doesn't start until a year's time, and households are feeling the pressure right now. But however, at the same time, the labour market is so tight, the unemployment rate is low, so households are actually, from a macro point of view, in pretty good shape right now. The issue, I think, comes in a few months' time when we feel those rate rises more. The RBA probably has to lift rates more to get inflation down. And we will get into the situation next year, at the beginning of next year, where households are in a much tougher position because they've had these cumulative interest rate rises, inflation's still high, and the cost of essential items like energy and food still remains very elevated. And that will be a problem, I think, for households, which is why we see consumer spending being quite low next year.
Diana Messina, Senior Economist at AMP Investments, thank you so much for joining us.